Why choose high-low breakouts over complex indicators? The labyrinth of the Holy Grail. Why we make our charts so complicated? When first stepping into the world of trading, whether it's forex or stocks, there is a specific image that almost everyone initially admires. It's the pro-looking trading environment, multiple monitors lined up, each displaying complex graphs, multicolored lines, and mysterious indicators woven together like a spider's web. If I can just master these many weapons, I'll be able to predict the future of the market perfectly. Successful traders must be using some secret indicators or advanced mathematical formulas that nobody else knows about. It's completely natural to think this way. Through school and work, we've been conditioned to believe that solving difficult problems requires complex formulas and highly advanced analytical tools. As a result, the very first thing a beginner trader does is decorate their chart screen. What starts as a single moving average somehow multiple into 3 lines, short term, medium term, and long term, still feeling uneasy. They add Bollinger Bands, then they crown the bottom of the screen with so-called oscillators like MACD, RSI, and stochastics. Before they know it, the chart is overflowing with indicators to the point where they can barely even see the candlesticks, the actual price action itself. However, despite equipping themselves with these seemingly powerful weapons, the irony is that their trading performance rarely improves. In fact, it often gets worse. This is because the more complicated you make your screen, the more likely your brain is to suffer a fatal processing error. When you sit in front of a chart packed with a massive number of indicators, the ultimate enemy that attacks you is analysis paralysis. Imagine a scenario where a certain currency pair's price is climbing and a great opportunity seems to have arrived. You want to execute a buy trade and stare intently at the screen. Looking at the moving average, a golden cross has occurred where the short-term line crosses above the long-term line. All right, time to buy. However, checking the Bollinger Band just above, the price has already touched the upper bands, plus 2 sigma, signaling that it's overbought. Oh, wait, it might reverse and drop. Looking further down at the RSI, the value is sitting at 75, indicating that the market is completely overheated. Maybe buying here is too risky after all. Yet, the market right next to it is pointing beautifully upward, suggesting that the upward trend is set to continue. When these many conflicting signals hit you all at once, what happens to the human brain? The answer is complete panic and hesitation. Technical indicators that recommend buying and those that recommend selling or sitting on the sidelines are actively fighting each other on the exact same screen. In a state like this, no matter how much you think, it is possible to reach the conclusion on whether you should buy, sell, or do absolutely nothing. Traders trapped in this analysis paralysis ultimately end up taking one of two actions. One, missed opportunity, doing nothing, inability to act. You hesitate and overthink while the price goes up, and away. Afterwards, you bite in your lip in regret, thinking, man, I should have just bought when I first thought of it. 2. Emotional overtrading, entering without an edge. After agonizing over the screen, you losing your patience and just hit the button based on pure gut feeling. When this happens, your reason for entering isn't any of the indicators you lined up. It's just a gambling mindset of it feels like it's going up. Overcomplicating your analysis strips you of your ability to make decisions. In the world of trading, no matter how brilliant your analysis is, you won't make a single penny of profit unless you actually press the entry button and hold position. In other words, information that causes you to hesitate is nothing but noise in the trading world. Why exactly do indicators confuse us so much? The answer becomes crystal clear once you understand the true nature of technical tools. Whether it's moving averages, Bollinger Bands, or MACD, these are all nothing more than processed data calculated after the fact, using formulas applied to the past closing prices of candlesticks. In professional terms, they are called secondary data or lagging indicators. In the market, the fastest and most accurate variable to change is the current price itself. The accumulation of the price becomes candlesticks, and the data calculated from those past candlesticks becomes new indicators. This means that by the time an indicator finally flashes a bullish trend signal, the actual price has usually already moved significantly higher. It's like driving in a car while looking only at the tail lights of the car ahead of you. The historical track. It can't warn you if there is a sharp curve coming up in the future. No matter how loosely or complexly you combine the shadow of the past, you can't create a magical formula that predicts the future 100% of the time. This is why many traders lose their capital and go broke chasing the holy grail. The perfect combination of indicators failing to see this core truth. After testing countless indicators, getting loose, and watching their funds shrink, many losing traders eventually turn a corner and join the winning side. The catalyst of this transformation is the concept of subtractions, stripping away all the noise and making the chart radically simple. The ultimate destination of this subtraction process is the very strategy we are introducing today, the high-low breakout strategy. With this approach, you completely hide the colorful lines and oscillators that used to clutter your screen. All you leave behind is the raw price action of the candlesticks and a few horizontal lines that you draw yourself. Why should you throw away all that sophisticated analysis just to focus on a rule so simple a child could understand it? Did it break today's highest price or did it break today's lowest price? The reason is simple. A breakout of the high or low is the single most pure and powerful piece of primary raw information, showing the exact moment when the will and energy of traders worldwide completely align. At the day's highest price, a massive cluster of orders, short sellers, stop losses, and new short entries is concentrated, acting as a wall saying, we won't let it go any higher. The same goes for the buyers, orders at the lowest price. When the price breaks through this wall by even a single pip, it means the balance of power between buyers and sellers has collapsed, and the market's energy has heavily tilted in one direction. This is an undeniable fact. There is no need to wait for complex formulas or moving average crossover. The mere fact that the price broke through that level serves as a powerful trumpet blast announcing the birth of a strong trend. By adopting this strategy, your trading environment changes dramatically. If it breaks the line, follow it without hesitation. If it doesn't break, close the chart and do nothing. Once the rule becomes this clear, the toxin of hesitation completely vanishes from your brain. Whether you are at work or on the go, the moment you open your smartphone and glance at the small screen, you will be able to instantly tell with 100% certainty if there is an opportunity right now. From here, we will dive deep into the exact mechanics of this ultimate time-tested approach, the high-low breakout strategy, including the practical steps using the phone and the risk management secrets requires to stay profitable over the long haul. Are you ready? Let's escape the complex labyrinth and master the art of trading simply. Three definitive reasons to choose the ultra simple high-low breakout strategy. Why should we choose high-low breakouts, a method that might seem almost primitive at first glance, as our primary weapon to compete against professional institutional traders and AI algorithms worldwide? It is completely natural to feel a bit anxious, thinking, is it really possible to win with something this simple? However, in the world of trading, there is a universal truth. The simpler system is, the more robust it is, the more complex it is, the more fragile it is. This strategy will become your compass to eliminate all hesitation and guide you toward becoming a profitable trader. This is driven by three decisive advantages. Let's dive deep into each one. Reason 1, the ultimate decisive signal of market energy, a trend characteristic that extends violently in one direction. The first reason to choose this strategy is that it allows you to exploit a very natural trend characteristic of the market. Once a clear direction is established, the price tends to extend violently and rapidly in that direction. Price movements in the forex market do not climb or fall in a neat, straight line most of the time. The forces of buyers and sellers are evenly matched, causing the price to bounce back and forth within a certain range. This is known as a ranging market or consolidation. Within this range, large institutional investors and retail traders worldwide quietly accumulate their orders, watching vigilantly to see whether the price will break up or down. So what kind of orders are sleeping right at the upper boundary, the day's high, and the lower boundary, the day's low of that range? For example, imagine the zone just above the day's highest price. A massive concentration of orders is clustered here, driven by two main factors. One, stop-loss orders, buybacks, from traders who went short, predicting that the price will drop from here. Two, new buy orders, buy stops, from breakouts traders waiting in anticipation, believing that if it crosses this line, a full-scale uptrend begins. The moment the price edges up and breaches the day's highest price by even a single pip, of all these orders trigger simultaneously, the short sellers' stop losses become market buy orders, and the momentum followers' orders become buy orders as well. In an instant, the market's order book is painted completely in one color, buy. This is the exact mechanism behind why the market shoots up like a rocket in one direction the moment a high or low is broken. This phenomenon is an absolute inevitability driven by human psychology. Unlike indicators signals, which frequently ends in statistical fakeouts. The forced stop losses of defeated traders physically push the market forward, resulting in a high, reliable, powerful extension. All we do is hitch a ride on the wave of this explosive energy the moment it triggers. This is precisely why even a beginner can snatch profits efficiently in a short window of time. Reason 2. An absolute principle unchanged for over 100 years, the pure power of primary data nearest to Dow theory. The second reason is that this strategy sits at the closest possible point to Dow theory, the most fundamental and absolute principle in the trading world. Formulated by Charles Dow at the end of the 19th century, Dow theory remains the holy grail and origin of all technical analysis for traders worldwide. Even in today's algorithmic or AI dominated market environment, no matter how much time changes, as long as the markets are driven by human psychology, fear, and greed, this theory will never become obsolete. Within that theory, there is a definition that is arguably the most famous and crucial of all, the definition of a trend, uptrend, a state where the market continuously breaks higher highs, resistance, and higher lows support. Downtrend, a state where the market continuously breaks lower lows and lower highs. To put it in incredibly simple terms, as long as it keeps breaking highs, no matter how much it temporarily drops, it is looking up an uptrend. As long as it keeps breaking lows, it is looking down, a downtrend. This is the single most transparent rule in existence. As mentioned earlier, the difficult indicators floating the internet, moving average market RSI, blah blah blah, are nothing more than secondary data. They take the price action candlesticks formed by Dow theory and process it after the fact using complex mathematical equations. Whenever information is processed and reprocessed, it coalesces, degrades, creating an inevitable time lag. In sharp contrast, the fact on the chart that the price has just broken today's highest or lowest price right now is completely unprocessed. It is the primary data, raw information itself, currently unfolding in the market. Professional hedge funds, bank leaders, automated algorithms, and everyone looks at the exact same price at the exact same microsecond, unlike indicators where interpretations vary based on formulas and parameters. The breach of a high or low is the fact that yield 100% the same answer, no matter who looks at it. This is the point where the focus of the entire trading world converges, making it the ultimate, most reliable basis of the market. A more trustworthy indicator simply does not exist. Reason 3. Completed on a small smartphone screen. Flawless reproducibility. The third reason is that it allows you to make a decision in a single second on a small smartphone screen, completely eliminating hesitation from your execution. The real reason most retail traders fail is not the weakness of their strategy. It is their inability to execute with consistency. In other words, they violate their own rules due to shifting emotions and hesitation. When sitting in front of a PC with complex chart displayed across multiple monitors, our brains are overwhelmed by an information overload. The 1 minute chart is up, but the 5 minutes is down. The 1 hour is ranking, but wait, what about the market? While trapping in this loop, your mental energy drains rapidly, and you eventually escape into reckless trading driven by gut feeling or panic. With this high-low breakout strategy, however, that worry vanishes completely. The rules of this method are stripped down to an astonishing degree of simplicity. If it breaks the day's highest price, execute a buy entry. If it breaks the day's lowest price, execute a sell entry. If it breaks neither line, do absolutely nothing. That is truly all there is to it. You don't even need to set up a laptop or lock yourself in a room. The moment you pull out your smartphone from your pocket and open your charting apps, the answer of whether you should enter right now appears in 1 second. Because there is only a binary digital criterion, has it broken the line or not? There is zero room for personal bias, your physical condition that day, or emotion to intervene. The simpler the rule, the easier it is to flawless reproduce the correct action without hesitation. Even during a busy workday or while out on the move, accumulating profits in trading does not require supernatural analytical powers. It requires the discipline to mechanically repeat a simple action that holds a positive mathematical expectation. This strategy strips away the greatest weakness, hesitation, and allows you to achieve the same flawless execution as a professional using just a phone. It is the ultimate high efficiency, time saving method, perfectly matched for modern lifestyle. Once you grasp these three reasons, it becomes obvious why discarding complicated analysis to focus exclusively on the line breakout at the highest and the lowest points is more than enough to win. Now, how do we configure these lines on an actual smartphone screen? Execute entries and handle the most critical part, taking profits and cutting losses. Let's move on to the concrete actionable steps in the next section. Complete on your phone. Concrete action steps for the high-low breakout strategy. The greatest strength of this strategy lies in its ability to complete every single process from analysis to execution on a single smartphone screen without causing you any hesitation, whether you are at work or on the move. There is absolutely no need for a complicated PC setup with multiple monitors. So, how do you actually open your smartphones, charting apps, identify the right opportunities, execute entries, and secure your profits? Let's break down the practical workflow into three clear actionable steps. Step 1. Identify the market's walls. Draw two baseline horizontal lines. The very first task to initiate your trading day is drawing two horizontal lines that will serve as the boundaries of the market. First, open a preferred charting app on your smartphone, such as TradeWeight, NinjaTrader, or your broker's proprietary app. Set your chart to the appropriate time frame. The fourth thing you must do here is wait for the market price action to settle down for the day, and then identify the current highest price, temporary high, and the lowest price, temporarily low. Once you have located these 2 points using your apps, drawing a tool to plot horizontal lines at the following exact positions. 1. At the very tip of the candlestick wick of the day's temporary highest price. 2. At the very tip of the candlestick wick of the day's temporary lowest price. With this, your trading preparation is 100% complete. From this moment on, you do not need to look at a single messy indicator. These two lines are not just a random marking on a screen. They represent the most powerful walls, resistance, and support that market participants worldwide are actively watching today. As long as the price remains trapped inside these two lines, the forces, buyers, and the sellers are evenly matched in a lagging market, meaning we do not touch it at all. The ability to clearly defined, this do-nothing time is the ultimate key to eliminating unnecessary losses. The only moment we are hunting for is when the price violently breaks out to the outside of these two lines. Step 2. Pure trend following. Enter with a breakout the moment the line snaps. Once your preparation is set, all that is left is to patiently wait for the price to move. We strike at the exact microsecond the price powerfully forces its way out of the two lines you established through the process of elimination. The entry rule is incredibly straightforward and represents a thorough trend following approach, riding the moment of the market. Buy entry when the price rallies and clearly break above your highest price line, or when a 1-minute candlestick body closes firmly above the line, you enter buy position without a single moment of hesitation. Sell entry when the price drops and slices below your lowest price line, or when a candlestick body closes firmly below the line, you enter a sell position without hesitation. If it goes up, follow it up. If it goes down, follow it down. This ultra simple behavior is the most logically sound approach to the core mechanics of the market. This is because the ungrounded counter trend entries that many beginners fall prey to, such as blindly selling because the price has gone up so much, it has to drop soon, will be instantly obliterated by the massive rush of buying energy unleashed by a high breakout. Breaking a day's high or low means that in the price zone ahead, there are virtually no historical opposing orders resistance left to block the path. The market has essentially entered an easy mode of open skis or bottomless pit. By simply hitching a ride on this momentum, your position can flip into open profits in the blink of an eye. Furthermore, by utilizing your phone's stop order, pending order feature in advance, you can set your orders right on the lines so that the app automatically fills in your entry the moment a breakout occurs, even if you aren't looking at the screen. Step 3. Your ultimate lifeline. Completely deciding your take profit and stop loss simultaneous with entry. The single most fatal mistake you can make in mobile trading is thinking about what to do next while panicking after you have already entered the market. When the price moves in your favor and your floating profits grow, you get scared of losing them and chicken out by taking profit too early. Conversely, when the price moves against you and the floating losses appear, you start praying that it will come back soon and postpone your stop loss. It will come back soon and postpone your stop loss. As long as you continue to trade based on these raw emotions, it is mathematically impossible to survive in forex. Therefore, this strategy enforces an ironclad rule. The exact moment you press the entry button, you take profit and stop loss orders must already be 100% determined and placed in the system. The concrete method for configuration is as follows. 1. Setting the stop loss. If a breakout fails and the price aggressively reverses back inside the lines, returning into the range, it means your market bias was incorrect. Therefore, you mechanically place your stop loss inside the line or slightly outside the most recent small candlestick high-low, cutting your losses immediately, while the damage is paper thin, using a lifeline to catching the next big wave. 2. Setting the take profit. Your profit target is determined entirely based on the size of your stop loss width. The core standard is to set your take profit target at a level where you can secure a 1, 1, or 1, 0.5 or greater reward to risk ratio relative to your stop loss width. For example, if your stop loss within is 20 pips, your take profit should be placed between 20 to 30 pips away from your entry price. By fixing your risk to reward ratio before the trade even begins, you can literally slide in a phone back into your pocket and just wait for the outcome. There is absolutely no need for you to anxious monitor the chart to see which orders gets hit first. You completely eliminate the emotion from the equation, leaving the expansion of your capital entirely to mathematical expectancy. Thank you.